Can you expand on the concept of risk-targeted investing and how this applies to portfolio construction?
Well, with risk-targeted investing, we put the question of risk tolerance with the advisor or the client because they're the one that knows how much risk they can tolerate. And so then our job is to maximise return for that level of risk.
And what do you see as some of the more underappreciated risks within a traditional balanced portfolio at the moment?
Well, all assets come with a bunch of different risks. You might have a currency risk or an interest rate exposure that you may or may not want. And so last year was a good example where interest rate risk wasn't going to be sufficiently rewarded given the inflationary environment that we're in, and central banks having to hike cash rates, which was going to mean that interest rate risk was going to hurt portfolios if they were exposed to that.
What are some of the challenges of a risk-targeted approach?
Well, it's different to an SAA or traditional asset allocation approach, which means that sometimes not all assets or strategies neatly fit into buckets. And so a risk-targeted approach tries to do away with all of those constraints and be more pure about the approach. But it means then that the approach itself becomes hard to classify for end clients.
And within an alternatives allocation, what is the universe of strategies you consider?
We try to be as unconstrained as possible. So really anything that doesn't require equities or bonds to keep on going up in order to make money can be part of an alternatives portfolio. But what's really important is that you don't have those exposures to equities through the cycle, because that's not going to be diversifying when you need that diversification, which is when equities are falling.
Is this type of investing suited to certain market types or broadly over the long term?
Well, no one should take risks that are not going to be rewarded, number one. And two, it's more suited to those who are less tolerant of risk. So particularly pre-retirees, retirees, ones that normally will rely on fixed income for diversification in their portfolios. A risk-targeted approach is a better way to diversify against the risk of loss for those types of clients.
And how important is smoothing that volatility when it comes to decision making?
Well, if you're exposed to large losses in your portfolio, it can actually change your behaviour. If you're a client that has a big loss, you might change your risk tolerance, or you might actually settle for a different outcome than what your objective was at the start, and that's the worst possible outcome for an investor. So smoothing the profile and avoiding those big losses helps give confidence to the investor that the risk tolerance they've chosen is correct.
What's your approach to investing into liquid versus unliquid alternatives?
Well, illiquid investments will have some restrictions in terms of obviously redemptions and applications. So we have we don't want to be constrained by the amount of illiquid investments we can have. There are some statutory limits, and we just try and work within the application redemption requirements that the portfolio needs and be as unconstrained as possible in terms of everything else.
And Praemium had a slide this morning talking about the trends in asset allocation to alternatives. Are you seeing similar trends in your own portfolios?
Yeah, for sure. And this is a trend that's been in place for a couple of decades now. And if you look at larger investors that aren't constrained just as we are, like the Future Fund, they'll have a very large allocation to liquid alternatives.
Glen Foster, thank you.
Thank you.